Good morning and welcome to this Wednesday, February 24th, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. All right, well, it was quite a day on Wall Street yesterday. Actually, last couple of days been kind of rough, and even dating back to our Max Payne webinar last Tuesday. We saw some gap downs. It's a little bit more controlled selling, but we definitely saw some selling. And now this week, obviously it turned, the selling, the heat on the folks holding stocks, the heat was turned up quite a bit, no doubt about it. We're going to get into all that in just a couple minutes. Let me first take you over to Earnings Beats. And for those of you who are new, we'd love to have you join our community. We do have a 3 times a week newsletter. Earnings Beats Digest comes out Mondays, Wednesdays, Friday mornings. Just sent a EB Digest article out earlier this morning, but it's completely free, no credit card required. You can unsubscribe at any time. It's really done just to give back something to all the folks that support us. It's very educational in nature. But just simply type in your name, email address, hit that subscribe button. Love to have you join our community. We do a lot of events too, and you need to be part of our community to come to those events, many events that are free. So there's obviously many reasons to join, but we'd love to have you. If you look over here, you'll see our portfolio performance off to a rough start this quarter for sure, although the income portfolio has done really well. And it's actually narrowed the gap now between the S&P 500 and its own performance since its inception back in 2019. So that's been one positive this quarter so far. But clearly the model aggressive and strong AD, which they tend to be more aggressive. They tend to be more focused on growth stocks versus value stocks. And as a result, I mean, if you've looked at growth stocks the last couple of days, has not been very good. And this, when we say this quarter, it actually deals with our quarter at Earnings Beats. It's not a calendar quarter. So our quarters for stocks are from February 19th when we select them until May 19th. That's when we sell all the portfolio stocks and we do it all over again. So you can see rough start. And I'll tell you, this was after a big rebound. Excuse me. Get some water. I'm still here, just kind of choking. Hold on, give me about 30 seconds. All right, I think I'm getting there. I think I can work through it. Yeah, this is like the first warm day, like really warm day we've had all winter. I think it's supposed to be like 70 degrees here in South Carolina today. And it might be, I know I have some allergies. I don't know if there's pollen or something, but maybe there's something going on. Anyhow, thanks for being patient there for a minute. Yeah, I mean, the portfolios themselves, you can see, we just put these stocks into these various portfolios. And as I was saying, intraday yesterday morning, these numbers were a lot worse. We had a really nice rebound yesterday, which in the daily market report that I sent out to members yesterday, I said I thought the market could go one of two ways. I thought we could either, really have a big sell off into the close, and finish weak, which would likely lead to more selling, or we could see a big recovery, which may have marked, I mean, if we see it, and we did see it, that may have marked a pretty significant bottom here in the short to intermediate term. We'll see. Now, I did see this morning, the 10-year Treasury yield's gone up above 1.40%. And go to CNBC, and the headline is, futures turn lower due to the 10-year Treasury yield rising or something along those lines. And, well, I'm going to get into the 10-year Treasury yield in a minute, but It just never ceases to amaze me how there's always something that's going to take the market lower. If you turn on news, you're going to find it doesn't matter what's going on. There's always going to be something that we're afraid of. But yesterday's action was very bearish in the morning and very bullish in the afternoon. Quite the difference. But the Dow Jones Industrial Average yesterday did go up 16 points. The S&P 500 up 5. The Nasdaq fell 68. It, earlier in the day, I think the Nasdaq was down 500. So 67, we'll take that. Mid caps rose 3.7 points, just a fraction, and small caps were down about 8 points. So they kind of fell about the same as the Nasdaq overall. As we look at the sectors, energy, very strong again. Energy's in a really nice uptrend. It too pulled back during the early session, early part of the session, but recovered, finished in positive territory, led the market to the upside. Utilities, earlier in the day, when the market was still quite a bit down, we saw mostly defensive groups at the top of the leaderboard. But that's normal when you see selling. That's honestly what I would expect. But when you see buying and market starts to recover, a lot of those defensive areas actually fell back. Utilities did stay up there. Utilities, though, quite honestly, when it pulled back, $60 was kind of a key support area. So I think we're getting a tactical bounce. I think utilities could do well here from this point forward on an absolute basis. I don't believe they're going to be a leader going forward, but I do expect all the groups to go higher in a secular bull market. So I think this is an area where we could begin to see utilities put in a nice little base and bounce. Communication services, really nice bounce off the 20-day moving average, which was down at 71.31. We actually went below that intraday, came back up above it. So still looking pretty good there. A lot of the internet stocks bounced back really nicely yesterday. Snap had a huge day. Upwork came back off of a really significant low and all the way down to like $42. And I have to say, or maybe it's 41. I was looking at the stock when it was at 42. I almost pulled the trigger on the stock. I knew they were reporting earnings after the bell, but the stock rebounded all the way to 52. And I was actually joking to my partner, John Hopkins. And I said, when earnings come out, it'd probably be 62. And it was up $10 after hours. I don't know where it is right now, but it did go to 62. So it was an unfortunate error on my part not to pull the trigger at 42. But anyway, internet stocks did bounce back really nicely, and that certainly helped communication services. Discretionary went down, was really struggling, but I like that long tail below the prior lows and then coming back up. We still did finish below the 50-day. Maybe we go back down and revisit those lows. I think we could be in more of a sideways consolidation period now for discretionary just because we did lose that 50-day moving average. But I don't think this is something that's going to be long-term. I think it'll be short-term. And if we can get back up above the 50, that would be a bullish short-term move. I mean, you can see we've gone below the 50 before. And when we've gotten back up above it, you can see the result. So the bearish side, I mean, if you're bearish consumer discretionary, you really want to see it continue to struggle below the 50-day. But if it moves back through that 50-day, I think you can see history is on its side in terms of being bullish. Technology, also a rough day, was down to about 128 and change intraday, came back up and closed at 132. So that was a really nice move back up. And that's why the NASDAQ came back up off those lows. It was because of the rebound in technology, because of the rebound in consumer discretionary. All the AD lines going across here and across all the indices still look really strong to me. Utilities being the one exception, that's been one of the weakest areas. But like I said before, I think we do start to see a rebound in utilities on an absolute basis. All right, the 10-year Treasury yield. All right, let's talk a little bit about this. First, we do have an economic report coming out later this morning. January new home sales expected to come in at 855,000 units. December was 842,000. So we are looking for an increase there of roughly 1.5% off that December level. All right, so as I look at the 10-year Treasury yield, and it's going up, back months ago, this was probably back in October and November, when I was asked, what's the catalyst going to be to drive the market higher? I said, rising Treasury yields. Money is going to rotate out of bonds, going to go into the stock market. It's exactly what's happening. The stock market is come roaring back, broke into new all-time highs, all the major indices. And now you turn on CNBC and it's higher interest rates that are going to, that are wearing on the market. Okay, first of all, you've got to take things in perspective. Rising rates are not always bad. In fact, like I said, when rates are low and the rates start to turn higher, that means money's rotating out of bonds. That money is going to go into the stock market. Now, it could lead to rotation in the market, and that's what we're kind of seeing a little bit here over the past couple of days, maybe even going back to last week. But there are other factors too that we have to consider. We talked about Max Payne last Tuesday. A lot of these NASDAQ stocks were way in the money to the upside heading into option expiration Friday last week. You might say, well, why? What about why is Monday and Tuesday? Why is it going down these 2 days? Well, anybody who exercises their options, call options, they own the stock. Market makers just simply move from sellers of the call options to sellers of the stock. They're short selling. Which direction does the stock need to go for market makers to make money if they're on the short side? Down. So one of the things you have to understand about the stock market is there is no worse day in the stock market than the Monday that follows option expiration day. Historically, that's not my opinion. That's a fact. Go back and look at it. Mondays after option expiration day go up only about 37% of the days. Ordinarily on the S&P 500, if we look back to 1950, 53% of the days have gone higher, 47 have gone lower. On Mondays after option expiration date, that is the lowest percentage of any day I've looked at, 37%. The annualized return is ridiculous. It's like minus 30% annualized return on all the Mondays that follow option expiration Friday. So this isn't just about interest rates. This isn't just about, 3 weeks ago, it was Wall Street bets. It was the Reddit traders. That was going to take the market down. Then we went to a new high, so they couldn't talk about that anymore. Now it's interest rates. And when the market breaks out again to new highs, it'll be something else. There's always something. All I can tell you is that higher interest rates from these levels is going to create so much money that is investable. And I think it's going to be invested in equities. That's the history of the market. Let me add something to this chart here. Let's go down and look at correlation. And we'll do this a little bit over the longer term too. But here's the correlation, the 10-year Treasury yield to the S&P 500. Now, you can see that we, over the last year, have spent most of our time above zero. The last 3 or 4 months, look, yields are going up. That's bad for stocks, right? Well, why is the correlation positive? Why is the stock market going up with interest rates? Money's rotating. That's why. So if you look back, and this isn't just something that you see in the, over a 1-year period. I'll change this to a weekly, and let's go back 10 years. Again, where do we reside most of the time? Above zero. Now you look at this and you say, well, the 10-year Treasury yield's going sideways and even went down, but the stock market's going up. How do you have positive correlation? Well, you have positive correlation because this is a 20-period correlation, 20 weeks. So it's constantly looking at 20-week periods, rolling 20-week periods to see the correlation. Now, in a bear market, what happens is when the yields are going down, all the money is, we're getting money moving into treasuries, and that usually is bad for the stock market because in a bear market, you've got all the money that's rotating out of the stock market going in. And then also folks are hesitant. I mean, when you've seen the market go down for 2 or 3 years, you're hesitant to put more money in. So when you stop seeing new money coming in a bear market and you stop seeing money rotating from the bond market, and in fact, rotating the wrong way, you get huge sell-offs in stocks. During secular bull markets, when you have rates dropping, like we saw 2014 to 2016, the market goes sideways and churns. Or even this period, 2018, we had a couple of really big hits. We had the trade war, we had the pandemic. So we had stock market hits, but the stock market came rallying back. Why? New money. We're in a secular bull market. There is money everywhere, liquidity. You hear people talk about it. The Fed's providing all this liquidity. They are. Economic stimulus. I mean, all these different things. It's hard to take the stock market down because you've got new money in addition to rotating money. Now, here you didn't have rotating money. You had it going the wrong way, but the new money kept us afloat. Now you've got both. You got new money coming in and you got money rotating. And that is really important. And in the short term, you're going to see that on the chart as mostly positive correlation. Anyhow, so I believe we're going to have GDP. I think it's going to be over 6% this year. I honestly do. I think that folks are so excited to get out. I mean, just people I'm around. People are so tired of not being able to go on trips or for things to be so restricted that it makes it difficult to go on trips or just to go out and have dinner. I think this year companies are going to see tremendous demand. And when you've got tremendous demand and you've got a Fed that's cooperating, you've got Congress cooperating, and you've got interest rates, quote unquote, soaring, give me a break. We're at 1.4%. Okay. Talk to me when the 10-year Treasury yield gets to 5%. All right. Then we might have some issues. 1.4%? I don't think so. This is awesome for the market. Now, again, it gets back to rotation, what areas of the market are going to lead. But with rates going up, there is no doubt in my mind that we're going higher. And yet, you pull up CNBC, and that's going to be your first headline telling you it's negative. It's a bad thing. The futures are turning lower because rates are rising. Come on. I honestly, I get so tired, and I hate to just keep pounding on it, but a lot of people that I talk to have no idea. They don't understand the stock market. They have no idea, no concept whatsoever what drives the stock market. And when all they hear is media telling them that it's going to go down because of Reddit, it's going to go down because of higher interest rates, it's going to go down, it's Great Depression 2.0 because of the pandemic. I mean, we've got a depression right now, right? Oh, wait, GDP is supposed to be 6%. Never mind. I mean, this is what you have to battle through. And so, yes, it's a rant on my part, but I also think it's so irresponsible by the media, and it's costing people a lot of money. So it infuriates me. I don't know what else to say. Anyway, let's move on. The QQQ, I wanted to talk about a little bit. Look at yesterday's action. Now, I'm also going to, let's get rid of that PPO. I don't need the PPO right now. Let's talk a little bit about the AD line. Because when you see a day like yesterday with heavy volume, oh, that's a weekly. I don't want the weekly. Let's try this again. So look at the AD. Just look at the candles on the QQQ. I'm going to shorten this so you can see them a little bit better. Let's just go back last 4 months. So I want you to look at these candles. We've gone down now 1, 2, 3, 4, 5, 6 days in a row. The QQQ is closed lower 6 days in a row. The AD line just broke to a new high. 3 of these candles are hollow candles. So we're getting, again, negative news. So we're gapping down at the open, selling off intraday, and then basically recovering. And the volume yesterday, 100 million shares almost on the QQQ. And we closed almost right on the high. Who was buying? Everyone was panicking in the morning. Who was buying? I think market makers were buying. I think you got institutions accumulating once again, just like we saw during the pandemic. Every time we come out with a fearful, something fearful, I mean, just pick a theme: Reddit, interest rates, pandemic, deficit spending, blah, blah, blah. Just keep picking them. Whatever it is, the media is all over it. It makes for great headlines. If the media comes out and says, oh my gosh, things look so great, market's awesome, we just, we got nothing bad to say, who's going to click on that article? You want to see the train wreck. Most everybody, I'm not saying everybody, most everyone's got kind of like a pessimistic side to him, always thinks the market's going to go down. And so when somebody writes a negative article, it's that bias. You're like, yes, it is going to go down. You're right. Let me click on this article. Anyway, big reversal yesterday. I think that's bullish for the market longer term. Short term, again, we're still in that period of the month, 19th to the 25th. We know the market tends to be weak. I can't tell you where we're going to go later today or tomorrow, but I am very bullish this market going forward. And so that's going to take me into my next discussion. Actually, I'm not ready to go into the next discussion. So the QQQ we talked about, I'm going to bring up, let me annotate something for a second. Okay, right here. Now, you know what this is right here? This line was when we had our Max Pain talk. And we had closed at 335 last Tuesday. We were 335 on the QQQ. And I pointed out Max Pain. That's the pain. That's the point at which market makers would have to pay out basically nothing on options. So it kind of offsets the calls and the puts, because up here we had a lot. I'm going to read to you. The QQQ by itself had a net call premium of $582 million. That was the cumulative net call premium, meaning if you took all the net or all the call premium that was in the money and all the net or all the put premium in the money, and you took the difference between the two, that gives you the net call premium, 582 million. Do you know where it goes to zero at? It disappears if the QQQ goes to 319 from 335. Now that was almost 5%. And, I said at the time, something along the lines of, I don't expect that we're going to go to 319, but do I rule out the possibility? No, I've seen it before. And so this time of the month, when you go into option expiration and you get into that 19th to 25th of the month window, you need to have the knowledge to know that we could be in for some weakness. There's your weakness right there. 5 days of it. 3 of it was big gap downs. Only 2 days did we have filled candles. I think it's manipulation. I mean, call it what you want, but let's, keep putting out those headlines on the interest rates. Interest rates are a big problem. I just showed you that higher interest rates generally go up, take the stock market higher. But for the media purposes, let's just call it interest rates this week. Let's go with it. So that's how you get prices down. Everybody panicking out. I mean, do you think that there aren't any individual investors that sold yesterday because of fear of higher interest rates? I think there are a lot of them. But nobody goes on CNBC and talks about the correlation, or well, few. They certainly aren't going to get the headlines. I keep going back to the media. I'm sorry. But in addition to the QQQ, I want to show you the stocks that we talked about last week. So the Spider was another one. Spider's come down some. S&P hasn't done as much to the downside, but the S&P, that ETF doesn't have as many stocks that are optionable. So I think the QQQ is much more subject to max pain, if you will. But the Spider came down from that February 16th close as well. I mean, we were down to 381. Max pain was 375. We got down to 380, 381 yesterday, 380. Now, here are the 3 stocks that I said we could see some problems with. 3 individual stocks. Twitter. Now, Twitter had closed around 74, 73.96. And yesterday's low went to 66.19. Now, that didn't get down to max pain, but it certainly cut into the $177 million worth of net call premium that was on the table. Just one stock, $177 million. So a lot of times what I do is if I like the stock and we're going into option expiration and I see this kind of potential damage that could be done to Twitter, I would hold off on buying. It's not just whether or not you want to short Twitter. If you like the stock and you're thinking about buying it, you need to know that there's $177 million worth of net call premium on the table going into option expiration week. That's kind of a big deal because it behooves market makers to take the stock lower. And at yesterday's low, we were 10% lower than where we were last week. I think that's noteworthy. How about PayPal? PayPal was another one I said. It was at 304.79. Max Pain was 259.01. We went down to 252 yesterday. I'm not making this stuff up. We got a live webinar that we recorded. You go back and check it out. It's what we talked about last Tuesday. Look at this, 5 days. And you know what? The first 2 days, there was no selling, gap downs. The next 2 days, a little bit of selling, intraday down to the 20, probably market makers. And then yesterday, on the huge move down, by the way, we tested price support, got close to the 50-day, big volume, and now we move up. Look at the AD line, getting ready to break out again. There's accumulation taking place. This was temporary. NEO, that was the other one I gave you, $59.23. Max Pain, $46.87. It got down to 41 yesterday. Now, for the real shocker, there were two that had net put premium, so they should rise. Well, all this carnage, I'm sure they didn't rise, right? Let's look at Clorox. So here was the 16th last week. You can see all the selling? A lot of folks had puts. So Clorox, at the time was 183.35. Max Pain was 197.81. We didn't get to 197, but we did get back up to about 192 a couple of days later. And we finished above in all the selling that's been taking place. You know, higher interest rates, right? That's bad for stocks. Well, apparently not for the ones that had a lot of put interest because Clorox went higher during this whole period. How about TAP? That was the other one I gave that should have some upside. Here's where we were. TAP 44.50, Max Pain 47.70. We got up to 47.19. Wait a minute, these are going the other way. Oh, that's right. They had put options. If you don't understand option expiration and the games that market makers play, I mean, it's astounding to me. And I've been doing this a long time. And every month when I look at this, it doesn't always work, but you need to be aware of it. I mean, this is kind of a critical piece of deciding whether to buy or sell a stock around this time of the month. Anyway, I thought that was pretty interesting. 7 for 7, the 7 stocks we talked about, the 2 ETFs, 5 stocks, all 7 of them did exactly what options suggested they do. Some of them crazy moves. NEO 59 to 41, PayPal 304 to 251 or 252. That's a lot of money. Oh, by the way, PayPal $152 million worth of net call premium. NEO $237 million. So, you know, don't feel bad for the market makers ever. Anyhow, all right, enough of that rant. I'm full of rants today. Media, market makers. The thing is, the market makers I actually like, because once you understand what they're trying to do, you actually have a little leg up in the market over a lot of other folks that don't have a clue what market makers do. All right, so let's move on. I got a question, actually a couple of questions from members yesterday, and dealing with stops. You know, the market was hammered yesterday in the morning. And so the question is, you know, what do you do with stops? How do you, you know, what do you do? I mean, you get stopped out and then a stock comes roaring back. Well, for me, and I always say this is the hardest thing about the stock market, is whether or not to have an intraday stop or whether to have a closing stop. I prefer closing stops. Why? Because I've talked about these long tails to the downside that tend to mark bottoms. I mean, you can see Peloton here on this chart in early September, went up to 92 or whatever. 2 days later was 72. That's going to trigger a lot of stops. But that reversal, we didn't lose any kind of key support. I mean, if I draw a line here on Peloton, I mean, there was your breakout. Here, see these tops? Here's your breakout. All we did is we went down and tested that support level and the 20-day moving average, and we recovered. But if you bought at 92, it would have been hard to stomach a $20 drop in Peloton intraday. I mean, I'm sure that was morning low followed by afternoon buying. That's usually a good sign for a stock when it rebounds off of a big move to the downside and then starts moving higher. So, and that turned out to be the low right there. You come down here, you have the earnings, you had a gap down. Next day it went down even lower. So from the time earnings came out, it was around 128, something like that. 2 days later, it was at 102. Or no, excuse me, it was at 92. How do you hold through that? I mean, that's hard, but look at the reversal that we saw. So in the morning, it looks like you should maybe have your stops in play. I can tell you this, morning trading gets you in trouble more than any other kind of trading. Morning trading is, I always call the first hour amateur hour. Yesterday, everything was selling off. It was awful. It looked like the market was done. We were heading into that Great Depression 2.0. The afternoon, it was like, what happened in the morning? I don't even know. I mean, saw stocks down. Amazon was probably down $100. It came back, finished green. Peloton, look at Peloton. It got down to 111, finished at 126, actually up $1 for the day. If you hadn't watched during the day, you'd have seen your stock go up $1. You know, nothing really happened. Well, if you watched it in the first 20 minutes, you know a lot happened. And so let me pull up the intraday. And so here, first 20 minutes. And I don't know what's going to happen to Peloton today, but a lot of times when you do start uptrends, and this, I don't believe we've started an uptrend yet, by the way. This was possibly a good start, but we got lower highs and we got lower lows. And so far, we haven't taken out yesterday's high. So we potentially could go back down again. We're still in a rough period of the month. I still think we could still be in this options related, although I think as you get further and further away from Friday, you start to move away from it. And that's why the stock market tends to perform better once you get past, the 22nd, 23rd, 24th. And then you actually get into a bullish period starting on the 26th, 25th at the close. Well, today's the 24th, so we're almost there. So short term, I don't know what's going to go on here. Longer term, all I can say is I remain very bullish. I believe growth continues to lead. Growth goes through hiccups. Yesterday was a really bad day for growth stocks. We actually closed below the 168 area, 166 right now. This looks easier to follow when we're on a line chart. So if I annotate this, so you see right here, 169 pulled back, went through. We've had tests this 169 level. We went down below that yesterday. That could mean short term, some additional rotation into value stocks. So I wouldn't be surprised over the next couple of days that, the growth stocks maybe take a little bit of a hit. Do I think the long term has ended on growth? No. Do I think this short-term breakdown means, we could be in for a little bit more rotation for a while? Yeah, I think it's very possible. That to me was the hardest thing about, when we put our portfolios together. It's not, do I want to be aggressive? I want to be aggressive. But even within aggressive stocks, within consumer discretionary, you have some stocks that are much more value oriented that really got hit hard during the pandemic that are starting to come back and show leadership. And we picked some of those. But I was trying to balance a little bit of that and still not give up on some of the areas I believe are going to continue to do well as we go forward. So yeah, I mean, it was that to me is the harder question to answer, is where's the rotation going to be, not whether the stock market goes higher. And ignore these comments and articles about higher interest rates being bad for stocks. Not at 1.4%, they're not. 5%, yes. That we need to start talking when the 10-year treasury gets to 4 or 5%, because you have to understand that gives portfolio managers somewhere else to go with their money. Now it's like, do I take the guaranteed 4 or 5% in the treasuries, or do I keep trying to get this 10% in stocks? It becomes a little bit more of a question. Right now, it's like, okay, stock market's going up 15% a year, 13% for the last 8 years. Do I want that or 1% in treasuries? That's a little easier call. Do I want to be so safe that I'm willing to give up potentially 12% of return to make sure that my money stays safe? I think as we move further and further into this bull market, I think more and more money is going to rotate. That's why I think rates continue to go up. I don't think they're going to go shooting up, and we'll have pullbacks. And when the rates pull back, what I will tell you is that when the rates pull back down, you're going to see money rotate back from value to growth, because higher growth rates in lower interest rate environments, that's where growth shines. And that's why we've seen such a big move over the last few years, is because rates have been so low. But so we're seeing a little bit of that rotating back right now, but I believe we'll see growth stocks leading again in time. The question is, what's that time? And I don't know. I'll be watching the market, try and find out. All right, let's take a look. I can't remember the third stock for the three. You must see there were 3 stocks I gave in the daily market report yesterday, and I'm going to pull them up. One was now I can't even remember any of them. I know. AOSL was one. And AOSL went down well below the 20-day moving average intraday, came back up and was about near the 20-day, I think, when I gave it in the daily market report yesterday. But the stock rebounded probably at yesterday's close. It was probably up about close to $2 from 34.50. I think it was 34.50. I can tell you because it was right around noon. Yeah, right around 34.50. So it did recover really nicely. That was a nice little recovery. Now it's again down a little bit. We're gonna have to, this downtrend could go back down. If you made money on that stock, probably wouldn't have been a bad idea to take some money and run. Tilray was the second one I gave, and Tilray is up another almost 2% today. Now this one has taken out yesterday's high, but it hasn't gone through gap resistance. But this was another one at noon yesterday. Talked about it. So I think it was 23 and change, 23.30, 23.40. I don't know, something like that. But now it's 25.20. I mean, that's, I don't know, 8% in 4 hours worth of market trading. It's a pretty nice return. But again, when you look at the stock, let me show you the reason I talked about this one. There's your breakout. So we broke out at $22 and went to 67. 2 weeks later, less than 2 weeks, we go all the way back down, test the breakout level. That's support. That was resistance, becomes support on a pullback, got a nice uptrend. Of course, if you're only looking at the market for the last 2 weeks, you don't see an uptrend. But overall, we're in an uptrend on Tilray. So we came all the way back down, tested this price support area. So that's why I liked it. Now, whether or not it can get through the 20, maybe it needs to consolidate for a while. I think it's a trading vehicle in the short term. So Tilray, I think, still looks good to me. But, even at this price, it probably doesn't look bad. But you do have to recognize you got potentially $3 to the downside. So if I was looking at Tilray at this level, I'd save some powder. If it goes back down to 22 or gets close, you could always add. And what I'll say about both of these stocks is that they're both very aggressive. So if you're someone who is, really allergic to high volatility, stay away from AOSL, stay away from Tilray. They're going to drive you crazy. If you're somebody who can deal with the volatility a little bit more and you believe that, hey, I can see some upside here, I'm willing to give it the downside. If I lose money, okay, I'll shake it off. Not a big deal. If you got that kind of an attitude, then Tilray and AOSL could be a nice trading candidate. Obviously better yesterday, but it might go back down there again. You might get another opportunity. Like I said, I don't think we're completely out of the woods here yet. It was nice to have the recovery yesterday. It was better than the alternative, but we still have some issues. Last one I'll give you is just a stock that, I've talked about. This was my stock of the year. Disney. Disney's doing very well. Back when we did the market vision, beginning of the year, and Grayson and David Keller joined me from Stock Charts. Disney was my pick beginning of the year I mean, I said I thought Disney could go to 240, 250. So it was my pick out of the Dow. You know, we've looked at our favorite Dow stocks. Disney was my favorite. And I just think, again, pent up demand. I think Disney's going to do extremely well. I think their parks are going to be absolutely swamped later this year. I think they're going to blow the numbers out of the water. I think growth GDP is going to be high. You got pent up demand, more and more folks going back to work. I think all of this is going to play right into the hands of a stock like Disney. All right, that's it for today. Let's take a quick look at the market, see what's going on here. Well, we got the NASDAQ back down 100 points. It's interest rates, right? Let's see what the 10-year Treasury yield is doing. Yep, over 140. Clearly, interest rates are impacting the market. Sarcasm intended there. Don't worry about the interest rates. Hopefully, the charts I showed you, that's the truth of what happens when interest rates rise, not what they're telling you on CNBC or any of these other websites. All right, let's wrap this thing up. Went a little bit long. Sorry about that. Everybody have a great day. I will be back tomorrow over at Stock Charts. And we'll do the Next Trading Places live recorded over there tomorrow morning, 9 a.m. same time, 9 a.m. Eastern. So hopefully you will be able to join me there. Everybody have a great day. Happy trading.